In part 1 of the video, we explored Warren Buffett's significant move of investing in Japanese companies using yen, signaling his concerns about the US dollar's strength and the nation's fiscal policies. Drawing parallels to his 2003 strategy, Buffett's actions suggest a potential prolonged decline in the dollar, reminiscent of the previous lost decade for US stocks. In this video, we'll break down his latest warnings, Buffett playbook, and what they mean for the future of the market. So it turns out Buffett isn't just worried about the amount of debt the US has, she's also concerned about who holds that debt. Because it's like the old saying, if I owe the bank $1,000, that's my problem. If I owe the bank $1 billion, that's the bank's problem. And right now the US is like the bank, and in this case that might not be such as if positions. This is a chart that shows how much of the country's debt is owned domestically in the US versus internationally. The larger top section shows that most of the new debt we've been accumulating is owned by a combination of US corporations, hedge funds, and citizens, while foreign ownership has stayed fairly steady for. Now, this might seem like area shoring sign, and isn't it good that the US government is mostly in debt to its own citizens, but with the compounding growth rates we'd talked about before, investors are worried about just how much debt US investors can absorb before foreign investors have to pick up the slack. And think of US debt buyers like a balloon. You can only stuff so much money inside of it and stretch it so far before the pressure force money to go out into the rest of the world. And that's the risk foreign investors start to accumulate more and more of the US's debt. Will they allow the US to keep on borrowing new debt to cover their old debt indefinitely? Because that's exactly what the projections say is coming. Brings us to some interesting parallels between Buffett's 2003 predictions and his move to Japanese stocks today. See, back in 2003, Buffett was focused on the US trade deficit and how it gave countries outsized influence over the dollar. But today, the situation is almost flipped today. The biggest shareholders of US debt are also the country's biggest trading partners, Asia and Europe. Shout out to Visual Capitalist for this great graphic. But there's 3 countries that stand out as owning large chunks of US debt, the UK owning G655 billion, and a longtime economic partner of the US, China, owning 867 billion economic partner, and a rival on the world stage in Japan owning a massive $1 trillion in US debt. But wait a minute, where have we seen Japan before? Oh right, Japan, where Warren Buffett just put $23 billion of Berkshire's money, while at the same time selling a bunch of US stocks. So what does it mean when the same country Buffett is buying into is also the biggest holder of US debt? Well, it isn't some grand conspiracy theory, but it's also not nothing. Japan has relatively low inflation, solid industrial companies, and a currency that historically has been seen as a safe haven, especially in uncertain times. But the US also needs countries like Japan to buy its debt if foreign investors decide that the US looks too risky or just want higher interest rates. Things could go downhill fast. Buffett warned about this worst-case scenario back in 2003, saying an abrupt shutoff in credit like many profligate overspending nations have suffered in recent decades with the country economically. So Buffett's shifting money into Japan, just as the US becomes more reliant on foreign capital. It's not just diversification, it's insurance in case global trust in the dollar starts to slip. Okay, so that's these tough. Everything's in place, but it still takes a spark to set anything off right. Now, we just have a bunch of people accumulating the US debts, but some analysts think that Buffett sees a potential catalyst for things to get moving in tariffs. Now, this is a nuance to pick, but having a basic understanding can help us make smarter investing decisions. So here's what matters for investors. Watching Buffett's playbook, Tariffs can, in theory, help reduce the US's trade deficit and thus boost the strength of the dollar. In fact, back in 2003, Buffett himself proposed by another name as a way to restore trade balance. But that's only if tariffs are done carefully without spooking foreign investors. And that's exactly what some experts think is happening right now. Buffett himself recently claimed that tariffs are an act of war to some degree, and Deutsche Bank warned in 2025 that the dollar's safe haven properties are being eroded and its reserve status is at least somewhat in question. Now, tariffs might not be the thing that triggers the flight in foreign capital, but the conditions are set up in a way that if the wrong thing happens at the wrong time, things could go south very quickly, and this time it wouldn't just lead to a weaker dollar or a lost decade in stocks. It could trigger an inflation, stock of funding crisis, or a major market correction. The phrase is overused, but it's kind of like a ticking time bomb at the center of the US economy, okay? But this isn't about panic. This is about preparing. Buffett is still optimistic about America's long-term future, but you don't become a scented billionaire by just hoping for the best. He is taking steps now to protect Berkshire in case the US doesn't change courses. Oh, even if the worst case doesn't play out, these moves can still pay off for investors. So what is Buffett's playbook, and what are some smart steps we can take as investors to protect ourselves? Assuming the road ahead won't be perfectly smooth, so with high fiscal spending, that's actually higher this year than last year, high dependence on foreign capital to keep the dollar strong, and some potential destabilizing threats to confidence in the US, it makes sense that Buffett is being cautious. But while Buffett is not a market timer, it's clear that he does adjust his strategy based on the data. So I think he's clearly seeing value in Japan, and I also think he sees this as a chance to hedge his bets on the US economy. Japan has a huge stake in the US staying stable, but Buffett's bet in Japan is also in yen instead of dollars. So he's kind of protected either way. If the dollar holds, Japan and Buffett's investment benefits, and if it falls, she's already holding a stronger currency. And so that's the first lesson we can take away from Buffett's playbook. There are 3 in total, but the first one is to diversify beyond the dollar. Now, Buffett might be buying Japanese stocks, but most investors can still get international exposure without needing to hold billions of dollars in yen, so passively investing in a broad market U.S. index fund is great to make up the core of a portfolio. Buying ETFs like VTI from Vanguard, SCHB from Schwab, or FZX from Fidelity all give you pretty good exposure to the U.S. market. But if we want to follow Buffett's example, we should look internationally as well. And this study by Kritzman and colleagues in 2010 found that international stocks don't always move in sync, and that opens up the door to higher returns with less risk. If we're willing to look globally, and multiple studies over several decades have found international diversification lowers volatility and reduces the risk that any one event will crash your portfolio. So an easy way for us to take advantage of this is to pair our US holdings with an international ETF to reduce our risks. If you're closer to retirement, you may want to consider buying bonds as well to reduce your volatility even more. So there's a few good international ETFs that you could use to round out a US portfolio. Some of those include VX from Vanguard, SCHF from Schwab, or VZILX from Fidelity. And it's not about abandoning US stocks. It's just about not putting all of your eggs in one basket. Buffett is currently sitting on a record amount of cash, over $300 billion in short-term US treasuries. But he's not doing that out of fear. He's doing it to stay flexible now. Buffett said it before: we will make our best deals when most people are pessimistic, so hold cash for when those deals appear, because eventually they always do, which leads us to number 3. To stay invested and stay disciplined. Buffett lasted 60 years at the head of Berkshire by always being balanced and following the data. If we'll look at this portfolio today, he's still mostly invested in solid US stocks. So it's important to be informed but never panicked. Buffett isn't selling all his U.S. positions. He's taking small, careful steps that help reduce his risk in a U.S. market crash. He's still optimistic, but it is smart to hedge against the risks. And I know that sometimes big events can feel scary, and we will absolutely see market crashes at some point in our lifetimes. But it's important to not make big changes to our strategy based on motion. Buffett has been through wars, stagflation, crashes, and bubbles, and what's worked every time is discipline, regular investing, long-term thinking, and avoiding panic. I realized while making this video that Buffett has been investing my entire life, and most people watching too. And if this really is his last shareholder meeting, the needle most feels like a final message is stay informed, stay invested, and follow the data. Note motion. If you found this video eye-opening, make sure to hit that like button, subscribe, and turn on notifications so you never miss a move from the world's smartest investors.